Hello, good morning everyone. This is Gary Dugan, the Chief Investment Officer here at Emirates MBD. It's ironic that I'm talking on American Independence Day when most of our worries are about the UK trying to make a break for independence from the European Union. But with some time to kind of think about what's going on and to absorb the initial reaction from markets, it's probably a good time now to think about how material is this Brexit as a challenge to the markets. What kind of things can we anticipate for the future? How do we make some money out of it? And how do we mitigate some of the risks? So let me just talk firstly about the kind of shock to the system, how we see some of the politics playing out, and then I'll move on to some views on asset markets. First thing to be said is that this did come as a big, big surprise, and I think it's been more the shock to what happened rather than necessarily the materiality of it that led to the very substantial adjustments we had in asset prices within hours of the announcement coming through. So I suppose the biggest event was really in the currency markets, where sterling, which had started in New York at around 150, disappeared down to 130s. And that kind of gave a measure of the shock that financial markets had to absorb as the news flowed through. When we move on to some of the political and economic things get a bit murkier, because we now have a process over 2 years when the UK will try to extract itself from the EU with a good deal. And the EU, I think, will have to deliver something that looks sensible.
The conference is recording now.
And so that the EU has to engage in a good negotiation with the UK, because I think as the EU is now waking up to the political fact that if they make a real hash of this, it's going to do as much damage to the European economy as it will do to the UK. So in broad numbers, we're seeing economists come in and say that the damage to the UK economy will be potentially to put it on the edge of recession through the next 1 to 2 years. And in the case of the European Union, to take about 0.5% off growth, which quite frankly would leave it feeling like a recession again over the next 1 to 2 years. Now, much of it will depend on politics. So much of what I'm going to say this morning is to give you some signposting of the things to look for in this kind of economic and political field, to give a sense of whether this is something that can be absorbed sensibly by the markets, not doing untold damage to global growth, or something that's going to feel a little bit more like some kind of Armageddon, where more countries start to or attempt to leave the EU. So what are the things we're looking for? Well, firstly, we've got to find out who's going to be negotiating with who. So in the UK, they now have to elect a new leader of the Conservative Party, who will of course be the new Prime Minister, and that will colour the approach that the UK takes in those negotiations. So the good news is that in the UK, that in the Conservative Party at the moment, we seem to have Theresa May coming out as certainly preferred by the parliamentary Conservative Party. She's well ahead in kind of soundings that have been made. The problem is the process to getting Theresa May to be the new Prime Minister is still some weeks away. We start this week with a vote in the House of Parliament by MPs on who should be the two candidates that then go forward to a vote that's held across the Conservative Party membership. And the eventual announcement of that will be on September the 9th. So that's still some months away, and therefore the markets will feel that they're in kind of suspended animation, waiting to see whether the membership of the Conservative Party agrees with the parliamentary party. It could be the case that Theresa May is so far ahead in polls taken within the House of Commons amongst the MPs that the candidates just pull aside and say, for the better good of the country, we'll let her become Prime Minister a lot quicker. And that, I think, will be taken positively by the market, and certainly would get a knee-jerk positive reaction from for sterling. On the European side, it is quite a mess, and just for me to kind of give you, again, a bit of guidance through that, firstly, the European Commission and the European heads of state are the two bodies that will be negotiating with the UK. At the head of the European Commission is Jean-Claude Juncker, who at the moment seems to be in a little bit of trouble with the German government and hence could be removed over the course of the next 6 months. And again, that might be seen as the market as a positive, as he is so pro-European. Most of the comments that he made immediately after Brexit were really not helpful, and suggested that, quite frankly, the EU were going to give the UK a real good kicking in negotiations, leading to a very poor outcome for the UK economy. But by implication also some damage will be done to the Eurozone as well. Angela Merkel, the leader of the German party, or German government, is trying to bridge the two sides, the real pro-European to the more sceptical, in order that a more sensible negotiated agreement can be made, really still engaging very heavily with the UK in keeping them a kind of associate membership of the EU, where they're still actively engaged in a lot of the politics, but not with the same framework that makes them beholden to the European Courts of Justice and many other things that, quite frankly, the UK electorate has voted against. In terms of the risks of other countries leaving, we have some time here before we probably know the answer. The Spanish recently voted, but there was no dramatic outcome from that election. The Italians voted before the Brexit vote, and they voted for some of the more extreme parties, but again, that isn't going to have an impact on the current government in Italy. But the greater risk is that next year, in the early part of the year, we get the French presidential elections, where Le Pen, who's from the National Front, she is a strong candidate for the presidency and will certainly get through to the final round. So again, that's something that the markets will be looking forward to, because the worst outcome there will be Le Pen and the National Front taking over the presidency, and on a rather anti-establishment ticket that would add further shocks into the Eurozone. So when we take the economic picture in aggregate, we've got an economy that is certainly going to be growing slower than we previously thought, and we've still got a very mixed political backdrop, but I think we've come on a long way from the initial shock, and I think things have been improving, but it's still something that could disturb the markets. The good news is, though, that policymakers are not standing still. They are trying to find solutions. So in the UK, over the last 3 days, we've had Mark Carney, the central banker, saying that to all intents and purposes, we are going to be seeing an easing of monetary policy. In all probability, we will have a cut in interest rates. I think the market still prices 50 basis points off rates by August. And even from the Chancellor, who was very much in the camp with David Cameron of trying to promote the idea of staying in the EU, he is now saying, well, if we're not going to do that, we've got to give support to the economy, and we will be at least minded to maybe more aggressively cutting corporation tax down to a target level of maybe 15% against the previous target of 17.5. So it's detail, but it's important that the policymakers, again, reflecting on what's happened, are trying to be supportive and are trying to encourage a better economic environment than perhaps we thought of in the immediate hours after the vote. So when we think about the future, we've still got asset markets that are vulnerable. And if I start with the easiest call, which is on sterling, sterling fell to currently trading around the 133 level on the screens this morning, in which it dropped to in recent trading sessions. And it is the, I suppose, asset class or the currency that is most vulnerable still to some downside risk. The current account deficit in the UK is really off the charts. Compared with history, we're down at 5 percentage points of GDP, which is the highest deficit we've had since the 1960s. In fact, since post-war records. So every day, the imbalance between imports and exports requires funding through capital flows, and because companies are probably going to pull back from making FDI in the UK without foreign direct investment, because they're uncertain as to the UK's position in the EU over the next 1 to 2 years, that imbalance in the currency market is likely to keep UK sterling cheap in the absence of a new flow of capital in there as people buy into maybe other asset classes. So we still hold out the risk that sterling could fall to 120, but it is maybe being offset if some of this political cloud starts to disperse and we see better engagement between the UK and the European Union. 133 still represents value in our view with sterling, But for those who are going to fine-tune any purchase of sterling, I'd say maybe look for a further lurch down, just through the day-to-day capital flows. Things then get a bit more difficult in terms of coming to really strong conclusions about the impact of Brexit on other asset classes, because all asset classes today are reflecting on a global economy that's still struggling to perform. So more recently, of course, we've got the difficult data in Europe and the UK, but when we look around the world, out to Asia, whilst countries such as China are still growing at a modest number, they're not growing at any accelerating pace. And in Japan, we've seen quite a lurch down in terms of growth recently, or I would say more modest amounts of very small numbers. So we've got Japan, which have been performing relatively well for a period of about 2 or 3 months, now giving us some very negative numbers that are going to require some kind of policy stimulus. So when you've got an environment where you've got weak global growth and you've got this shock to the system, our bias still is to recommend clients to be very much focused on fixed income markets, even though those yields are being crushed down to some of the lowest levels that we've seen in some time. So by and large, we look for, I would say, a consistent backbone of a portfolio, still very much biased towards fixed income. If the global economy gets into trouble here and we start to see disappointments and growth because of the EU's problems and the UK, we could potentially see the US 10-year down to 1.20 from the kind of 140s that we're in today. And that would lead, I think, to still quite substantial risk aversion amongst a lot of the kind of bond markets. And therefore, some of the more riskier assets that we were perhaps more comfortable with in the past, we're just a bit more circumspect on. And that would be particularly in the kind of high yield space, where spreads in the past have been much higher at points of times of difficulty in the global economy. So when you build a portfolio, we're not saying exclude high yield, but maybe whereas in the past it was a one-way bet because there's been so much kind of good news for bondholders through relatively low levels of growth and an economy that's holding in, the risks of a kind of a fragmentation of Europe, disappointing growth in Japan, maybe a rolling over of the US economy, all that will be extremely good news for US Treasuries, but wouldn't be such good news for high-yielding bonds and higher-risk bonds. So just be careful in that high-yield space and get the right measure of your exposure in your portfolio, but you should retain government bonds, even though, around the world, quite frankly, we're looking at profoundly low yields. That would still be the asset class of choice during these kind of difficult times. The one area, though, of credit markets that is still well supported by quantitative easing is the European zone. And remember, that's not just European companies, but also US and GCC issuers that also issue euro credits. And those markets are still very well supported by a backdrop of ECB intervention in the market, as they, quite frankly, are buying up almost anything that moves in euros in the corporate debt market. And some of the more regional markets of Europe that we're particularly focused on include some of the higher yielding bank debt that you can get in the Scandinavian markets as just one kind of specific side idea. Now, all hope is not lost in the equity markets. We saw the rally from the low point, so you can still see that people are very, very keen to get engaged in asset markets when you see significant setbacks, and we wouldn't disagree with that. But I always say to investors in this environment that you really should only buy things that you want to be left with. When things get tough and all of a sudden there's a big turnaround in markets, you don't want to be left with poor quality companies in your portfolio. So we've been much more focused on high quality plays that have maybe just seen some modest underperformance. And in recent market movements, we're looking to the food manufacturing, that big staples such as Procter & Gamble's, Coca-Cola's, and Unilever's, and equally in the healthcare sector with companies like Johnson & Johnson, Pfizer, Eli Lilly, and others that are mentioned in some of our notes that we put out immediately afterwards. Interestingly, I think institutional money has moved that way as well. So although there's always a lurch into higher risk companies that have markedly underperformed, irrespective of their quality, We believe institutional money is still very much focused on quality and on those companies that continue to perform through different market environments. And we remain in the global economy that still struggles. Just one thought, though, is for a higher beta play would be in the energy sector, where the benefit of strong dividend yields, even although some of those projections are being cut back due to the lower oil price, we're still seeing good money for the energy sector, and that's, again, another part of the global equity market we would buy. But I stress again on dips. Specifically in the GCC, again, we prefer yield. Our yielding portfolio has been doing well for us. And we would also look towards the telecom sector. Quite frankly, just more phone calls made during a crisis than less. But also, clearly, those companies have got a strong control over tariffs. And all of those companies are typically yielding somewhere between 4 and 7% between the Etisalat, Dues, and Saudi telecoms of this world. And one last market we would just keep an eye on, because we always want to buy this market into any weakness, is India. The Indian story is still very robust. It is not particularly damaged by what's happening in Europe any more than anywhere else is. It's got good trading links with Europe without damaging the long-term prospects for GDP growth in India. So you're still looking at a good monsoon season. You're still looking at a lot of confidence that government policy and maybe the current negotiations around GST could come to a positive outcome as well. All of that still adds up to, I think, a good second half of the year for the Indian equity market. But as always, we prefer to buy it on dips rather than to chase it higher. So just to summarize, because I'd like to open it up for some questions very shortly, there was the initial shock. There is now the policy reaction, and I think there is some political movement. The policy action is to provide some support for the UK economy, and we're hearing from the European Central Bank that they stand ready and able to provide support for certainly the bond markets, which is where we concentrate our focus. We are still seeing, I think, downside risk to sterling. We are still seeing some downside risk to asset markets. Our preference is to have a heavy bias towards fixed income and some exposure to equities, but looking to buy into the dips and only in quality areas. I'm just going to quickly just talk about real estate. Real estate in the UK has been dipping, and I think you're going to see potentially some very good opportunities, not just because of the movement in sterling, but also because there are going to be people out there who are going to be panicking out of some of their assets, and clearly places like London were overextended. Is there much of an impact on real estate locally? I very much doubt it. There is a positive. It's that probably the Federal Reserve is going to be more circumspect about increasing interest rates. So I think there were concerns in our own local market we could see a higher interest rate. That's now unlikely to happen, and that will basically provide a boost to a market that's clearly struggling under the weight of slower economic activity. So my bottom line is it could have been a lot worse. I think things are getting better. We've still got a lot of challenges, but you've still got to be very, very careful in the way in which you invest. Being safe and secure is very important, as well as looking for the opportunities if we see any setbacks anywhere close to the levels that we saw in the immediate aftermath of the Brexit vote. Okay, let me pause there and see if there are any questions.
Gary, hi. Thank you for the presentation. I'm very happy to be invited. My name is Jem Saral, and I work for an oil trading company based in Dubai. I have a quick question about your comments on India based on your perceived potential for future growth. What are the most likely investment ideas through Emirates and sources with regards to your India strategy? Thank you.
Yeah, so I think it's best if we come back to you specifically for anything that you may be looking at in terms of individual securities for India. As a CIO, I don't normally like to give individual stock ideas in case someone comes back and says you got all those wrong. But no, I mean, in terms of the specific areas, it's a couple of themes. One is that we've just heard the announcement of the increases in salaries and pay remuneration for the civil servants, an event that happens every decade. There's a tremendous amount of GDP created just through that announcement, and that typically lends itself to a positive view of the consumer sector, where we'd expect to see both the domestic auto sectors do well and the broad consumer sector do well. And it could even just have, help for whether it's technology as people buy more televisions and mobile phones, or just greater consumption in those areas. So I would say that very much lends itself to the consumer story, which is a very long-term theme of a rising middle class, but also the near-term benefit of the improvement in the improvement in civil servant salaries. And not to be forgotten, and a more powerful impact, if it comes through as hoped by the weather forecasters, is a strong monsoon season. We've had 3 years of very, very poor monsoons. If farmers were to get a good monsoon this time round, and I think people then would actually have the expectation that for the next 1, 2 or 3 years, that should continue post the El Nino effect this year, then even farmers would have more money in their pockets and go out after 3 years of really not having the cash in their pockets to catch up on the consumption of durable goods. So a lot of factors there running in support of the consumer sector, but we can come back with some specific recommendations to you directly.
Thank you very much. Much appreciated.
Hi, Gary. In terms of your views mentioned about the equity markets, but we are seeing some stress in European banks. What is your view on European banks, especially on the Italian and Spanish banks? We are seeing a heavy selling after Brexit. So do you see a systematic risk there, or what's your view on that?
Yeah, a good question. So the European banks have been the Achilles heel of Europe ever since the financial crisis. Unfortunately, unlike the United States, they didn't get their house in order, and a number of them are still vulnerable and still haven't got their capital ratios anywhere near where they need to be, or indeed where the regulators and authorities have pointed them. So Deutsche Bank, you can see on your screen, still remains at close to its all-time lows. And I would say the Italian banking system in particular still remains very vulnerable to any significant setback in asset prices. Now, how systematic or how big a problem? I think it is a very big problem, and I don't see any immediate solution for it. I think the hope had been that the UK would stay in, and the UK would, in some senses, be part of trying to find a solution through lending its weight into providing the resources in order to get Italian companies or Italian banks recapitalized, and similarly for some of selectively within the German banking system. That's still not been achieved, and so the greatest risk for me, and quite frankly across all the markets at the moment, is of some kind of credit event that leads to a markdown of the value of existing loan books, which we know the Italian banking system is already struggling with the mark-to-market that we've seen thus far. So were we to see, let's say, 20 to 30% off equity markets, that would lead to a very sizable further impact on their balance sheets and a further challenge in terms of their capital raising. And I think the only answer longer term is for a number of these companies to have to go into public ownership, be absorbed in a sense by the European Central Bank, and then trying to work out the problem. But I think it's still a shock that can still happen to Europe. But I think it's probably at least a year away, because I think at the moment the European Central Bank is still very credible with the markets. Everyone believes they really are doing their best to be very supportive, and that incrementally at the edge they were achieving something. So I think as long as that credibility remains there, we're not going to worry so much about this credit event. But I think 1 to 2 years down the road, this is going to be a big problem. Okay, I'm sensing there aren't any more questions, and we said we'd keep this to 30 minutes. So thank you very much for calling in, and we look forward to talking to you again in the future on other topics. Thank you.